Welcome back. It's time for top picks from Ryan Bushell. Number one, we go back to that pipeline space. We've talked about it a couple of times, Ryan, through the course of the show. Pembina Pipeline, ticker symbol PPL on the TSX.
Yeah, thanks, Paul. And so back to Marco's question earlier, hopefully he's still watching. This is the type of company you can purchase today at nearly a 6% dividend yield with a lot of growth opportunity in front of it. So when you look at the natural gas market in North America and Pembina's opportunity within that gas market, largely they're a gas processor, so separating out dry gas from the liquid stream. This was basically a tough process over the last decade or more as dry gas prices were very, very low, and it was only the liquids that the companies were making money on. Now, with the possibility of LNG Canada coming on stream 2025, 2026, natural gas prices offshore being extremely attractive, that now becomes a two-sided opportunity for the producer, where both the gas and the liquids are valuable. So Pembina is in a great spot to be able to facilitate that for clients on a long-term basis. And so again, when you're thinking about Marco's question of what's a dividend stock I can own, well, I'm already starting from a 6% dividend yield. That means I'm going to get my money back. If the company just pays the dividend steady and the share price goes nowhere, I'm going to double my money on the company in 16 and a half years. Now, if they grow the dividend and the share price grows, that's where you get even more return. And so holding that company that has that sustainable opportunity in front of it, collecting that dividend, reinvesting it if possible, and seeing some dividend growth, to me, that's a great long-term opportunity. The shares have come off from around the $50 level down into the mid 40s, and to me, that's a very attractive price on a long-term basis for clients. So right now, I'm looking for those very attractive opportunities that aren't related to consumer discretionary spending, and this will be one of them.
Next, we go to an engineering and construction giant whose shares are trading at their lowest level in about 2.5 years. ACON Group, ticker symbol ARE on the TSX.
Yeah, so a really tough quarter for ACON after many quarters of really solid results. They were forced to take some write-downs on some fixed price contracts, which again were entered into half a decade ago, maybe even more than that, on the basis of a world that has significantly changed. Now, maybe that they own some of that responsibility, but at the same time, that was just the way business was done then. So it's a difficult business. The large construction business is a difficult business, but because of that, there are very few qualified players. If you look forward for ACON from here, the share price has been trashed. The dividend is intact and I think can be maintained at the current level. And they have a great opportunity set in front of them. They're signing their largest project in their history with Metrolinx that'll be signed in stages over the next few years, so it won't all hit backlog at once, but it will be a steady source of increasing backlog for the next 5 years or so. Combined with the fact that on a longer term basis, they're really one of the most qualified and only qualified Canadian constructors anyways in the nuclear space, which I think again is seeing a revival. You've seen the news out of Japan and even Germany this morning. Nuclear is getting a second life here out of necessity, and ACON I think can be a part of that, at least in Canada and potentially on a North American basis. So like the company long term, and again, when looking at opportunities right now, I'm either looking for really beat up opportunities or really great opportunities, and this actually fits both, with a 6% dividend yield at current levels. Again, you can't park money at 6% with that much opportunity very many places, and I think ACON is a good buy from here.
Okay, Algonquin Power, you said right at the top of our program that your portfolios for clients are heavily oriented towards, among other things, power generation. Ticker symbol here, AQN.
Yeah, so really an ideal mix between power generation and renewable development opportunities, combined with a base business of utilities where they can continue to green their fleet and get paid for work they're doing to upgrade the infrastructure. And then the utilities no more prevalent than the Kentucky Power acquisition that they're currently working through. So the shares have been pretty range bound between 17 and 20 for quite a period of time after some pretty substantial growth up to that point. But I think the company is just consolidating and waiting to hit its next level of growth, and you're getting paid a nice 5%-ish dividend yield while you wait. So again, to Marco's question earlier, this is another company I think you can own on an even more sustainable basis potentially than Pembina, with a great dividend yield, some dividend growth ahead of it, and a lot of people will try to shoot their lights out with that first stock purchase. I think one of these more steady companies, you might see they won't shoot the lights out right away, but looking back on it 10, 15, 20, 30 years, you'll be pretty happy, I think.
Okay.